as a speculator, like at this point, I've lost.
All right, I'm going to go round up the troops, and we're going to get started for the decentralized insurance meetup.
I mean, everyone I talk to, it's frustrating too. When you talk to like 22-year-old we have 4 years old veteran. One is not like money anymore.
Alright, so just wait. Alright, cool. So I made the call. People start seating themselves. I'll just start off by saying that we are here in St. Petersburg, Florida, at the Sawgrass Tiki Bar. So I'm drinking a kratom, and other people are drinking kava. So basically going to be talking about a new distributed application using Ethereum. It's going to be focused on insurance. And before we do that, I'm going to give a quick introduction to what Ethereum is, and then jump into a Q&A with our guest speaker, and then have the presentation go forward. So I'll quickly give a round of applause, and just to kind of see what we're working with here. All these pretty people. All right, cool. So, oh yeah, and there's Chris. What's up? So Chris will be presenting later. Let's see if I can figure out how to do my own screen here. Cameraman. Okay. All right, so just by a show of hands, who here would say that they are very familiar with Ethereum? Who here is unfamiliar? Okay. So I just want to start off by giving a quick introduction to what Ethereum is. It's a fairly new software platform, kind of developed in the beginning of 2014 at the Bitcoin, North American Bitcoin Congress, something or like that. So anyways, over the past like year and a half, a team has come together. They've done a crowd sale of Ether, which is the main currency that's that Ethereum produces. So all of this information is available online. I just want to kind of go through it quickly to just give you an overview. So it's referred to as like Web3, so it's like the global internet. It's decentralized. There's nodes running the Ethereum blockchain around the world. Basically started, from Bitcoin with kind of having a distributed ledger, but then the idea is how do you take smart contracts beyond money? Hence, different types of things that you can do with it. For example, the main language is a JavaScript-based language called Solidity. There's other ones called like Pyth, Geth, Python, Go. There's also C++. So there's a lot of developer tools. One of the main things is with Ethereum is that you yourself can create a bank, issue your own currency, kind of define what the parameters of that currency are. And this is the website that we're on right now. This is called Homestead, and Homestead is the second version. The first one was called Frontier, and it's basically for like developers to kind of get in there and start playing around with the tools. But now it's getting to a point where like average users can start playing around with it. So you can make your own bank. You can also do a crowd sale, which I'm most interested in. It allows you to basically be your own Kickstarter. So Kickstarter takes their third party. They take a 15% cut out of all the projects that get successfully funded. But what if you were able to just issue your own token to people who buy into your system? So that token then can be exchange for the product or return back for the money. So it's a lower risk system for people who want to buy into your idea. So this is where things start to get a little bit more, I guess, intangible. So you start coding jobs. That's what a DAO is, a distributed autonomous organization or distributed autonomous company. And this is what we'll talk mostly about tonight, but how do you code jobs? Or how do you kind of code a company? So this is kind of one of the most exciting aspects to Ethereum because it offers the most opportunity for change. And luckily tonight we have a great use case of how that can be applied for insurance. So I'm trying to think. There's a lot more you can learn online. There will be a new release of the browser called Mist. So once that browser gets into the ecosystem, Ethereum's going to grow pretty rapidly in terms of providing more use to users. Because right now you do have to be pretty technically savvy, yes.
What about the nodes? Are the node runners compensated, and if so, how?
So from my understanding, there's two ways to operate a node. One is to mine. The other one is just to passively keep a copy of the blockchain. So if you want to mine, you have to have a more powerful computer setup. But if you just want to be operating on just a simple board, so for example, Internet of Things, they may not be mining, but they would just be keeping a copy of the ledger. If you want to go take a look, the people who are leading the way in terms of efficiency in computing, 21 Computers has a Raspberry Pi that can passively, basically run a full Bitcoin node. So Ethereum has also released like a Raspberry Pi software. We kind of played around with that at a previous meetup, but I think we kind of came to the conclusion that that Raspberry Pi is nowhere near capability for mining for profit.
But maybe an obsolete Bitcoin mining rig would actually work, right? Because this is Ethereum, and it's not that much.
No, I mean you're still competing for for blocks, yeah.
Is a bunch of it in China like Bitcoin?
Bitcoin is predominantly in China, yes. Ethereum, they do have a pretty big Shanghai meetup, at least from what I've seen online. But I have a feeling that this will probably be popular in China as well, maybe even more so. But I was doing mobile app development in China for about a year, so I know that the industry, internet pain points in general, from my perspective, are pretty big. But the funny thing is for most Chinese users, they don't even know that the internet's blocked because they have all they need inside the walled garden, unless you want to start organizing or being critical. So is anybody here on Twitter? Would you guys just mind sharing this link? I put it up in the meetup group, in the Facebook group. Just say, hey, at Ethereum, we're live broadcasting. If somebody wants to do that. So that's basically it. Right now, if you have a Linux computer, you can download the software. Homestead is just 3 months ago, we were looking at Frontier, which was this is obviously a marked improvement. So. Now what I'd like to do is just kind of a couple things that I've been following in the news lately about Ethereum that I would like to kind of just bat off a couple ideas. So the price of Ethereum has been going up, and great for Jerry. But I guess the question is long term, what happens to that price? Because there is a contradiction. One of the main aspects of Ethereum is that the currency that it creates, Ether, it's used as a gas to run the engine of the computer. So if gas is high, you drive less, right? So, but if gas is cheap, you're able to, run more applications, deploy more connected devices, what have you. So I guess the question is, where does the Ether price point kind of come down so that you can then scale whatever applications you're running? So I don't know if anybody has any thoughts on that.
You probably, for it to property in the most effective way possible, probably should have went from forward to Ether, right?
I'm sorry, what?
In order for the Ethereum to propagate fastest or as fast as possible, you wouldn't want to like forward Ether itself. Like you would want it to be, I mean, just like.
Well, Ether's not. I don't look at Ether as an investment currency, just because for Ethereum to prove successful, the price has to become cost competitive to what it would cost to pay Amazon for that hosting. So it's definitely like something I've been thinking about, but it'll just be interesting to see how that progresses. Come on in. We're just having a chat.
But so you're saying that like say you have like 90% of the users, right? If someone else tries to make an application, they're going to have a hard time, right? Like deploying their.
Well, nobody's going to own 90% of the Ether.
Okay. Yeah.
Is there a hard limit, like the 21 million on Bitcoin?
Oh, that's a good question.
Yeah.
There is, okay.
Yeah. And as far as I understand, there's a limit on the amount of gas that you can spend at any one transaction. And again, Ether goes out to 8 decimal places, I believe. And so when you're spending gas, you're spending those fractional units. I think it's something like 500,000 or 1 million, out to 8 decimal places. So you're not even spending 1 Ether when you're doing an operation. So these operations could be on the order of pennies or maybe $1.
But if you're running, billion devices or whatever it is, that's a significant cost, even at that price point.
And as the exchange rate goes up, that fractional Ether does become more and more. So there will be an effect. I'm not sure how much economics will play into it.
So there's no number like 21 million. It's more the Vitalik Buterin guy who started it all. Could he decide, hey, there should be twice as many Ethers?
It's in the system. No, it's a program limit on the amount of Ether. What they did do in this latest release for Homestead was they changed the gas price, or the amount of gas that was required for certain operations, and so that's something they could do. They could say the cost of operations is now way cheaper, and so if the exchange rate goes real high, they can offset it. But that's a hard fork. They had to change the software itself to get that to work.
One thing that worries me actually, the price goes too high, is competitive platforms are really trying.
So I'm going to just reposition this here, and then I think we can kind of go into a more a deeper dive, because to date, Chris, you've gone the deepest into the weeds. So I guess I'll introduce you just briefly, and you can add on that. But you've been working on this decentralized insurance scheme. You have a background working in insurance. What do you think for you was the kind of the turning point where you said, okay, I want to go down this road with Ethereum?
This idea in particular just has been haunting me for a couple years. Honestly, it was something I felt like was inevitable. Somebody was going to figure out how to do this. And I'm not saying that I've figured it out, but I have an idea that I had to get out of my head. So I spent the last 2 months doing the research and quantifying it in a white paper. And so these are just ideas. I did a certain amount of prototyping to work out some of it. But now I'd like to put it out in the open and kind of release myself. Along the way, reading a lot of research papers, I found that there's several other ideas worth building on Ethereum. And so some of those I think I'm going to very quickly start pursuing a little bit. But that was, I guess, the turning point when I left my last insurance job. I said, I've got to get this out of my head before I go to the next place, because I can't think about this for another year. And I'm glad I did. I'm glad today was the last day, putting the period on the last sentence.
And as you're kind of learning the Ethereum framework, what were some of the things that kind of struck you as like innovative or especially interesting?
Well, I'm super impressed with what everybody's done with such a short amount of time. There's already people producing insurance products on Ethereum. There's already people producing viable, monetizable ideas on Ethereum, and it's only really been out since July of last year. So it's a super hot space, and it's really interesting to be in the middle of that. I'm captivated by the potential. I think, like everybody else is, the idea of building these corporations, these new forms of corporations, maybe new kinds of work that didn't exist before. I do get a little philosophical the more I think about it, like where humanity may be headed and how these are, this is happening in our life. This is happening right now.
So I read, just to make it a little bit more current event style, I read an article in the New York Times yesterday. It seems like they're just finally starting to get around to Ethereum. And it was, what, newspapers try to do is sell conflict in terms of framing the story as Bitcoin versus Ethereum. And I think that that's probably the wrong way to look at it, because it's not either or, it's a yes and. So I guess, how would you see like Bitcoin and Ethereum kind of coexisting, and using the insurance scheme as an example?
So one of the problems I ran into almost immediately was people don't want to buy insurance and get payouts in Ether or whatever. They want to deal with dollars, at least for now. And so I already was having to figure out the exchange issue. How do I get from your dollars to Ether behind the scenes, and maybe a few other hops in between? And one of the best solutions I found was to go from dollars to Bitcoin, and then there's a technology called BTC Relay, and that is for essentially syncing up the Bitcoin blockchain with the Ethereum blockchain. You have these runners that will watch the Bitcoin blockchain and watch for certain transactions, and they'll post them over to the Ethereum blockchain. So you're kind of duplicating one blockchain onto the other, but what it gives you the ability to do is you can have a system on Ethereum, and the owner of that organization on Ethereum owns a Bitcoin address, a Bitcoin wallet, and they say, we'll provide this service as soon as we see a deposit at this address. And so BTC Relay keeps the things in sync, and those relayers are being compensated for moving the blocks over. They're just the headers for the blocks, so it's really optimized. That's fascinating, and that's why those two things are going to be able to live together, because it doesn't have to be an either or at this point. They've already come up with a solution to make, something very established work with the newcomer.
So another thing that takes a little bit of time to wrap your head around is this idea of employee-less company. And what you've essentially done with your white paper is listed out that architecture for how that company would be structured. What were some of the lessons that you learned in understanding how a employee-less company would work?
Well, originally my hope was you could have a true peer-to-peer architecture where I would be insuring you and you'd be insuring me and that guy, and we'd all just use the software to facilitate. But along the way, and maybe it's not unique to insurance, maybe it's a lot of companies, you don't actually get rid of the employees. They just change their roles. So they become independent agents, and they provide a service to the insurance company. Maybe a good example of it is an Uber. So if there was a blockchain or an Ethereum solution for Uber, they are free agents. They can take any hard job they want for that day. They can take as many as they want for that day, but they are truly independent. And in a sense, that's what's happening with the insurance solution. The people that were doing the underwriting or doing claims or doing something like that aren't being employed by the company, so their interests have changed, but their skill set is the same. And they're going to be an independent agent providing a service that they're being compensated for.
I'm a little fuzzy. I'm just speaking loud for the presentation there, but I'm a little fuzzy on what we're talking about. Are we talking about mortality and expense, or are we talking about the operations of the insurance company? I mean, right now, as I sit here, the only thing I can guess with my knowledge of blockchain is X event happens. It's provable by this something happens, and automatically money was dispersed. The transaction was triggered upon an event. Is that what we're talking about here? And what does that have to do with employees and agents stuff? Okay.
Well, that is what we're talking about.
Okay.
But you still have people that provide some service. So, somebody that's an underwriter. or something like that, and they would become agents. They would be people that perform an underwriting function, but they don't work for the company.
So the insurance scheme that you're describing, not only is it better for the end user in terms of the person who's getting insured, but it's also beneficial to the person who's doing the insuring.
Right.
So in this case, it's just you become a freelance agent?
Essentially.
Okay, so I guess you're eliminating the bureaucratic jobs, but you are empowering the human-oriented soft skill jobs, or I mean, how would you?
I think so.
What are? I guess my question is, what are the economic employment opportunities with this new decentralized insurance scheme?
Well, I think one of the ideas about these distributed autonomous corporations is they aren't able to modify themselves. So they are a block of code that performs a known function. These rules are programmed out, and everybody can review them, and they know how the company works. But you still have to have the last mile, if you will, the human element. And so these agents are going to be that last mile. You're still going to have people surrounding this organization performing whatever human function needs to be done. And I think that that's kind of the idea. These are organizations. This is a group of people that are getting together saying, we'd like to work together to do this thing, to provide this service to each other.
Does your paper, is it okay if I ask another? Does your paper include things like E&O, where we didn't enter that formula exactly right, so it didn't disperse the money like it should have, and so even those things have their own triggerable insurance policies for E&O?
So I really focused on some of the more mainstream insurance products or commodity insurance products.
Oh, okay.
But I guess the idea of some sort of specialized insurance, you could put it into the same framework.
Okay.
A lot of the more high-risk scenarios, I suppose, are going to be covered by structured products where you're selling them off as bonds to investors of different sorts. And that's very typical in insurance today. So,
one question I have, and this is just speculation, but having worked at large insurance firms before, how are they going to adapt or co-opt, or what is it going to be their reaction to this?
I'm not sure. I have a lot of contacts, and I was talking to them today about maybe the implications of this. And just to be humble, I think that I've got to take it on the road still. I got to talk to people and see what the reception is.
Mm-hmm.
From the time that I spent at insurance companies, they're very big, they're very slow to react to technology, and I think it's just part of what happens when you're inundated with regulation and legal frameworks and security concerns and all that sort of thing. I really don't think any of the mainstream players are going to be interested in blockchain insurance. They'd like to know about it. They all have science departments, and so they have one ear to the ground, if you will.
Mm-hmm.
And they issue their own internal white papers on things like this. But there's so many startup insurance companies that have popped up over the last couple years, and I really think part of it is due to interest rates being so low that everybody's searching for yield, and maybe they're taking more risky investments and they're funding some of these new startups. But there's so many of them coming out of the woodwork. I really think it's going to be a small guy that's going to do blockchain insurance.
Maybe your best avenue is reinsurance. So one of the few things I know about insurance is there's all this reinsurance stuff in the background that normal people don't even know about at all.
Yeah.
But you gotta know about it.
Yeah. It's part of the white paper, and I really do think that has been where a lot of people have been flocking to. So much so that they've had oversupply of cash for the last 3 years, and the effect was reinsurance rates have dropped 30% in 3 years because it's been one of the larger profit centers.
So you describe this tool. Where do you hope that it goes from here? In terms of how do you hope that people can contribute, or in the spirit of Ethereum is more of a bigger tent for kind of pulls more talent.
Right. So I spent a lot of time just in my cave working on this idea, and mostly just the ideas for a white paper. I'd like to make everything I did open source, all the prototypes and all the little pieces open source. I'd like to keep conversations going and see who's interested. There are so many pieces that need to be built, and very few of them could be closed source. They have to be open source just because of the nature of Ethereum. So if there's any hope that I have, I hope it interests people enough to start building. And even if I'm, just advisory, at this point, I would just like to see some sort of innovation happening in the insurance industry, especially blockchain related.
I'm just curious how for insurance work. Does it have to polish, have to sort of write, so everyone's lost will into the company platform, or is that correct?
Right.
So let's say there's a claim. Does everyone equally agree on the payout of the claim, or how does that get done?
So I've got kind of a structured scheme where there is a reserve pool and money is going to come out of the reserve pool. But I needed to figure out a way to incentivize people not to commit fraud. So the people, I'll talk about it in a little bit, but the people that submit your claim, they're a little bit on the hook. And the people that vouch for the person that submitted your claim, the people that vouched for them and said they're trustworthy, they're a little bit on the hook too. And the people that built the insurance product itself, if they built it poorly and it's causing too many claims to go out, they're a little bit on the hook too. So there is a small amount of a structure where multiple people are incentivized to be honest or accurate, but there is a reserve pool that takes the bulk of it, let's say 90% of the claim.
And what you're looking into what? Casualty, property, and things like that?
Right.
Properties. But I think it's very interesting. Very interesting. So the idea how many people it could be, isn't it?
This is the white paper, and because of the legal and regulatory prohibitions, none anytime soon. This is, in my opinion, if there was an MVP that just showed test data running through a system within a year, that would be the best case scenario. But there's people with money that are willing to pick that fight and make it something that's realizable. Yeah.
Okay, so I think this is a good chance for me to turn it over to Chris. So I'm just going to go ahead and get the presentation all queued up here, if I can. Okay. So because we are running a Google Hangout, this is going to get a little tricky, but I think we'll be able to do it. Okay, that did not do it. Okay, let's try that again. Okay. All right, now we are there. Nope, false. Sorry. Closer, closer. Okay. All right, I think that's it. Okay.
Cool.
Great.
Awesome. All right, so like I said earlier, this is a presentation on a white paper that I just put the last finishing touches on this morning. I've had very little review. There's a couple contacts I have that are in the insurance industry and some that are in the crypto finance industry, and I've just had some very cursory reviews from both of those contacts. So this is, I'm looking for feedback. That's pretty much what I'm saying. And I'm also switching gears a little bit. I'm pretty confident that the ideas I've put together can at least instigate some conversations. So I'm at the point where I want to go instigate those conversations. So what we're talking about today is insurance in the blockchain, virtual corporations, so people that are familiar with Ethereum, that's its bread and butter. and how do you do financial trust with these virtual corporations, and what are the implications for the future of insurance? So my background is IT solution architect in the insurance industry for last 3 years. I've been doing crypto finance development, specifically with open transactions. It's a cryptocurrency library, not blockchain based, it's more client server, but it's got some big implications for exchanges. You know, all the exchanges run away with their Bitcoins. Stash Crypto is a company that's looking to solve that, and they use open transactions. And before all of that, the thing that hooked me into finance was I was doing currency trading. I was just a day trader, but did it enough to where I got interested in automated trading and market structure and things like that. So that kind of led me down the path. I just want to kind of set the agenda and say, we'll just briefly go over insurance today processes and problems, some terminology for crypto finance, some existing projects that are already doing things that are similar I thought were interesting. What I think are some of the key ingredients for transforming what it is today to what it could be tomorrow using the blockchain. Then a suggestion I have about the structure of what a blockchain insurance system would contain. It's a kind of just like a topological map showing different components and some of their uses. And then what I think could be some very loose plan for building a system like this. So this is just a very high level process flow showing insurance today. Starting on the left side, you're going to have risk model creation done by some actuarial people. Those are your data mining or statistics people that are going to look at a set of historical policies, some data about potential customers. They're going to crunch and crunch and crunch and try and find out like what a realistic risk model would look like if they were going to make policies. And they're also going to try and figure out, well, if we make this into an insurance product, we know what the risk factors are. How big does the pool need to be? What are some risks that we don't want to deal with? So getting reinsurance for those things. So they're kind of the data scientists or the analysts. Exploration of submission just means that's you filling out the forms and telling them, you know, some things about yourself. And then third-party data is going to be if you're getting car insurance, they're going to go get your driver history, or they're, you know, it's a house, they're going to go look at wildfires in the area or something like that. So they pull all those things together and it goes to underwriting. Underwriting is where they give you your quote. Binding is where it's officially a policy. And then really after binding, if you don't have any claims or you don't move or something like that, the only time you're going to be in contact is at renewal. And then it's just a loop. It's a very low touch business model. So like I said, it's linear, it's low. These are what I feel like are kind of maybe not problems, but these are some grievances. It's a linear, low touch business, and it's really becoming commoditized. People are getting to the point where they only really care about price. And so a lot of insurance companies are suffering because of that. There is no relationship with your insurance company. It has a, relatively speaking, a high cost of getting new customers, and that hurts them. The cheapest are the online direct vendors, and the call now and save 15%, whatever the Geico commercial is. They have lower profits so one of the ideas is they're really making their money on the interest income from your premiums. They take those premiums and then they go buy bonds or something like that. And when interest rates are yielding less than 8%, they suffer, so much so that they raise premiums to pass it on.
Bastards!
Well, they're also suffering because they've reached saturation. Kind of the customer growth is low for a lot of the mainstays in the insurance world. You're getting a lot of competition from the online direct vendors or some of these startups. And firsthand, my experience working at insurance companies is they lag technology severely. They are, sometimes it's because of regulation or security concerns. A lot of times I think that it's a beast. These companies are so big, they just can't move very quickly. in process or otherwise that get choked. So just a moment of humility. There's a graph that is the hype cycle for any given technology. And a group called Bought by Many is a peer-to-peer insurance company. They put together a hype cycle for the insurance technologies. And it just says, there's always, in the beginning, a lot of talk and a lot of interest and a lot of, this is going to be the best thing ever. And then some realization sets in, and there's a crash of expectations. And people kind of lose interest for a while. But then some real innovation starts happening. And then, people become interested in it, and it actually is a technology that's viable. On this hype cycle, we're talking about this today. So you can see we've got a long way to go.
Well, as I understand the hype cycle, it's just the time it takes for kind of like the public to get like up to speed.
Right. Well, absolutely. So there is a bit of that. There's going to have to be a lot of innovation before it becomes so undeniable that the public really understands what this means.
So I guess my question would be is like, let's say you run with this idea, you get as many developers as you could fit into an organizational team, build it out. Even if you have a finished product, people will still take time for people to like adjust that technological inertia. So, I mean, not to say anything, just nice crack.
Well, I borrowed it, so thank you. So just a couple of quick terms and definitions. Blockchain simply is shared public ledger, key-locked accounts. The ledger contains some key-locked accounts and transactions.
When you say key-locked account, you're talking like multi-signature or just like any type of
private key?
Okay.
Yeah. A node is a member of the blockchain network, and they validate their copy of the blockchain. Cryptocurrency is a currency system secured by cryptography. So it's secured in two ways. There's key-locked accounts, and then it's secured using hashes, and that is just for validation. Making sure that the transactions they have were actually done by those keys for those accounts. Bitcoin, the first blockchain cryptocurrency, released in 2008. Today it's worth $420. Smart contract is the code stored in blockchain accounts. It's capable of a few things: storing some data, moving cryptocurrencies between accounts, linking to other smart contracts, so calling out to other smart contracts. Some other things I didn't put in here, and they're kind of related to the idea of key locking an account. You can set up the idea of identities or access controls, so you can get some fairly sophisticated functionality by building, user management, if you will. That storing of data gives you the ability to have a certain amount of databases, very lightweight databases. Something that smart contracts are also able to do is you can submit new smart contracts to an existing smart contract and have it update or switch over to use new functionality. So these are smart contracts that can change over time. So Ethereum is a blockchain smart contract system released officially with Frontier in 2015. Today it's worth $11.50. I think sometime back in January it was worth $9 or somewhere around that. So percentage-wise, it's increasing pretty quickly. So the thing we're talking about today is something called a DAO, a DAO, Distributed Autonomous Organization. That means companies that live in Ethereum or in a smart contract blockchain. It's a company that's represented by a system of smart contracts on the blockchain. And then the other thing we're talking about today is oracles. And just as a footnote, this is probably, if we're going to be building DAOs, oracles are probably where you make the money. Generally speaking. And those are external systems. So DAOs live on the blockchain, interact with the blockchain, can perform all sorts of functions, but only with things that are represented on the blockchain. They can't reach out. So oracles reach out to the blockchain. They operate in the real world on servers out of Amazon or something like that, and they are trusted by a DAO to give it information or to perform actions on its behalf. So those, like I said, I think are the more monetizable of the whole ecosystem. So there's a couple projects that are already doing interesting things with blockchain insurance. One is Augur, and it's not typically considered an insurance system, but it does have some features that kind of look like that. It's a prediction market. So you can go on Augur and you can give it any sort of scenario, and then people will bet one way or the other on an outcome for that scenario. So a good example of how we do that today is weather futures are traded on the CME. So you can say, I want to buy, I'm having a big outdoor event in Arizona on this date, and it costs me this much money to set up this outdoor event, so I'm going to hedge that. I'm going to buy a weather future or sell a weather future so that if it gets rained out, I'll make money over here, from this future, this weather future contract. So it's kind of like insurance. And today I went out to Augur and looked around, and they had this exact prediction was out there. Will there be rain in Phoenix, Arizona on this date? That's a weather future, acting like an insurance contract.
Has anyone yet started doing presidential elections stuff?
Yes, there was.
So Augur just moved out of, the first thing that you run to on Augur is Hillary Clinton, Donald Trump, etc.
Yep.
Primaries, general elections, but I think they just now moved into beta.
Right.
So now they were in alpha, and it was kind of like, I don't know, there weren't enough people, and they're going to make it a real predictor market, but now I think it's
Yeah.
You can go online, you can play on the app too, and see what bets are out there.
And yeah, since it's beta, some of them are silly, but it's the fact that they put the plumbing together. It's very viable. Yeah. There's any number of people betting on it. So one of the features I thought was most interesting is automatic payout if you win the bet at the expiration date. So that is kind of like a claim without any of the review process or anything like that.
So they have to decide on some protocol that's not great.
It's a bet. So I guess you're right. It could rain, and everybody bet against it, and so you lose. I guess that's part of it. But the idea
The thing is, who's the authority? That would be the oracle.
It's true. It's true.
National legislature.
Well, isn't it? I thought Augur, you had to, if you own a share to Augur, you get a vote to cast saying what the outcome was.
Right.
And then based on that, you get paid out as well for
Well,
casting
there's
correct vote.
two parts to it. One is the percentage of people who think it will or will not happen, and then there's the actual event happening. So I guess the prediction market is to get more and more experts trying to figure out what will happen. But when the time comes, said happens, then who is the trusted oracle source? In this case, whatever the weather shirt is.
Right. So I think it has enough of the mechanics of some sort of insurance type product to just be a good example. This is a much more, I suppose, mainstream insurance product, flight insurance. It was a competition in London last year for blockchain-based technologies, and they pulled this together really quickly. And what it does is you can buy a policy, let's say, for your flight, and it uses an existing Oracle service that runs on the Ethereum network called Oracleize. And so you give it your flight information, it goes and hits the Oracleize smart contract. Oracleize goes out to the internet and looks up your flight. and if it's late, automatic payout. I don't know how they planned on doing any sort of pool management or reserve funds or anything like that, but it was an interesting, indisputable way to run a claims process where that data is publicly available and this service was already available. Oracle has it. You can use it for any web service or web data you need to collect from your smart contract. You can contact the Oracleized smart contract, tell it what URL, give it some money, and it'll go out to the internet and pull back the data for you. And the last one that I saw was Dynamis. This one I don't think has moved much past their white paper, but their idea was to do unemployment insurance. Again, they were going to use Oracleized and LinkedIn to verify if you're employed or not, or at least to know when they should start the claims process. They were going to depend on other members of the pool to determine if you were actually unemployed. So there was a more official claims process where they were going to ask, and they had a formula for it, how many different people were going to need to validate your claim. All right, so
I have a question going back to
yeah.
The insurance, or just kind of derivatives. So I just finished reading The Big Short, which is basically a story of how people took out insurance bets on the people would make their home payments on time. With this new kind of decentralized insurance program, do you see more derivatives taking place? I mean, do you see another kind of like 2008 financial crash, kind of some Big Short happening again using this?
I'm certain there's going to be more derivatives. I'm thinking that a certain amount of it can be localized failures. So what I mean by that is you can have, with structured products, you can kind of wall off the potential losses into littler and littler pools. And that may be one strategy they use to protect it. It's hard to say how the money could flow in the worst of situations, but I'm sure that they're going to be interested in structured products just because it gives them access to outsized yield when they have the best of times. They can get high yield.
I know another one of the issues is determining what is the going price for a derivative, because at least from The Big Short, the problem that they're having is nobody can tell them what their derivative contracts were worth.
Right.
Because what's the other side of the market? So it seems like there would be more transparency into what is the real value of that policy.
Right.
So I guess that's one huge bonus in terms of getting that instant payout.
Right. Right.
Your own calculation.
Right. Well, and it's going to be difficult to say that these are directly analogous with each other, the derivatives today versus the derivatives that are online. There may be situations where, and this doesn't happen today, where the derivatives just unroll themselves and you give back as much money as you can, and it's considered a liquidation event. And you have to, the policies, everything unrolls itself, and you have to reorganize a new pool as a stopgap measure to keep everybody from losing everything. And there's no laws on the books that say anything like that is possible today. So I don't know, maybe if we're going to put things on the table, we should put everything on the table and see if there's just a better way to handle it all.
Do you have any concerns about how to take the money, any money, brought back from cryptocurrency into cash without having
Absolutely.
without IRS being over?
Absolutely. Yep. It was, if this could all be done in Ethereum for simplicity reasons alone, that'd be wonderful. There is a group called Maker, and they're actually integral to this whole solution. Maker produced their own DAO, and what they do is they create a stable coin, a coin that is pegged to It's actually pegged to the SDR, but SDRs and US dollars are pretty closely linked themselves. So they didn't have a good solution for it either. At the end of the day, they said to get from dollars into our currency, you're going to have an oracle, essentially. So they called it a custodian. And in all of their examples, they're recommending setting up these custodians in far-off islands, or jurisdictions that are going to be more amenable. And so I think that gateway, the dollar gateway, is always going to be a choke point. And it's a matter of time, though. I mean, these cryptocurrencies are inevitable. So as soon as they're a bit more widespread, maybe it'll be less of a concern. I'm seeing enough countries around the world already investigating issuing their own cryptocurrencies to feel like it's inevitable on a whole lot of levels. So the next part of this is where I'm going to just go over some of the major tenets I feel like would be required to transform where we are today to where we could be using a blockchain insurance system. So, well, I'll go through a couple of these just to describe what I mean. So the first one is an easy one. Management decisions become smart contract code. For a very long time, the concern was technical automation or technical unemployment was going to wipe out the people at the bottom of the corporation first. But smart contracts are making us realize that it's actually probably going to be the top of the house and the middle management that goes first. Because for businesses, especially like insurance, it's very formulaic. I mean, I showed you the flow chart, and it's pretty easy to understand how you make money from that. So that's what's going to happen. You're going to build a management structure in smart contract code. Few of the other ramifications of this are that some management decisions were to hire people or to procure some service from somebody or something like that. And so one of the changes that goes along with a company being smart contract code is instead of paying people for time like we do today, there's an idea being floated of paying for performance. And so what that means is, it's kind of like the Uber example, where you would say, I have a task with a very specific outcome that I need to be accomplished, and I'm going to attach a bounty to accomplishing that task. And the first person that shows up and does the task, they get the bounty. And it's as simple as that. Publicly available list of things I need done with all the bounties, and whatever your skill set is, however long you need to take to do this, whatever technique you need to do, isn't important. I'm more interested in the task being accomplished. And it can even be formalized, some of them. Like you could say, this insurance company says, I want to be on the first page of Google, the first search result page of Google. And it can be validated using that Oracleized service. And you could say, I'm willing to put $1,000 on whoever can get me on the first page of Google first. So the race begins. There's probably a lot of examples that could be orchestrated that way. The next one is what I was talking about earlier. So we have to figure out a way to go from fiat currency, so just national currencies like dollars or euros, we have to switch to a fiat-pegged cryptocurrency. So this group, Maker, they came up with something called the DAI, D-A-I, and that's their internal currency. It's Ethereum-based. It's kind of like a colored coin, but they've taken a certain amount of Ethereum and they collateralize it with whatever your collateral is. If it's dollars or euros or bitcoins or stock or whatever, and they'll issue you a certain amount of DAI. And it's a stable coin. They peg it to the SDR. So the SDR is issued by the International Monetary Fund. It's been around since about the 70s. You can't get it. It's only owned by central banks. But the volatility for the last year, did a quick calculation. It's only moved 0.9% in a year against the dollar. So it's already pretty stable to the dollar. And it's in its volatility over the year was less than 5%. So up and down, it pretty much stays point for point with the dollar. So it's a good, for this problem in particular, where somebody buys a policy today, they want to have some predictable premium every month. So cryptocurrencies move around a lot relative to the dollar. So you need something that kind of is pegged to the dollar. And also the payout is important, because if they bought a 20-year life insurance policy, you don't want the value of the currency in the reserve fund to drop so much that in 20 years it's worthless, or it wipes out the entire pool. So the idea for this transformation is incorporating Maker's technology, incorporating their smart contract structure, and using DAI as the internal currency to the insurance company. You would still need some way to go from dollars to DAI. And so they introduced the idea of a custodian. It's a special kind of oracle. And they would be fully responsible for all the legalities of how they do this. But if it's going from dollars to euro, or to dollars to DAI, that custodian would have to have a reserve fund that they set up. And they'd have to publish their finances so everybody can see you got a reserve fund, with all the dollars in it. And because you have that reserve fund and everybody can see it, you're allowed to issue X amount of DAI. And then they had a concern. What if they run away with the reserve? So they incorporated an idea of a custodian trap. And what that means is they have to set up a special structure that Maker has access to, and in that structure, they have to put all their stock, some sort of other collateral. It's kind of like an escrow account. So if they are concerned about their finances or whatever, they can liquidate the escrow account and get the money back. So it's really expensive for these custodians to do what they're doing. And I imagine it's going to be an impediment for a while for getting anybody to want to be a custodian. But that is kind of the cost of having these distributed systems and trusting people financially.
And their payout would be percentage, whatever we think back for.
Yeah. And so, like I said earlier, BTC Relay is one of the other ways that we already know Bitcoin has a pretty healthy exchange rate to dollars. And for people that want to use Bitcoins as their collateral, BTC Relay gives us a way to go from the Bitcoin blockchain to the Ethereum blockchain. And it's pretty much implicit, the way that it's the way that they stay in sync. Just people compete to move the blocks across, and they get paid for that. And so, and it's one of the accepted collateral types. They also suggested that in the future you could have custodians that deal in gold. So they are gold custodians trading into DAI, or they can use their own corporate stock to trade into DAI, or things like that. So that's, I hope, going to be a major portion of how we solve this conversion from national currencies into cryptocurrencies, and back and forth, using the Maker DAO solution. So here is what I was talking about with kind of the repositioning of human resources from being employees of the company to becoming independent agents. So the underwriting function is where you take in somebody's information and you price out how risky they are. You set their premium. And claims is the other side, where they've got an existing policy and something goes wrong and they want to pay out. So both of those functions in this model are merged together, and they become oracles. So again, insurance company lives on the blockchain. Oracles are these humans or computer systems that provide trusted information to the blockchain or respond to things the blockchain wants done in the real world. A type of oracle, so let's say this is life insurance. The oracle would be your doctor. So they would be the person that's most intimately knowledgeable on your health conditions. And they would have access to all your medical records. And they would have software that would take your health information and they say, okay, you want to use this insurance product from the blockchain? Okay. The people that drafted this insurance product, they gave me a risk matrix, so I'm going to run your medical information through a risk matrix, and you get a fitness score from 0 to 100. And that fitness score is the only thing that gets pushed out to the blockchain. Now, they're an oracle, so their opinion is trusted to a degree, but that's where we get a certain amount of anonymity on the blockchain. People can buy these policies, and the system can have a certain amount of trust that they understand the true risk represented by that person.
So I guess the question is, in terms of the reputation economy, or saying, let's say we want to insure you, we somehow provide, like, go and check some third party, like, check your browser search history, or, your credit card history if you've been spending a lot of money at bars, what have you, if you're an alcoholic. Do you see that coming into play in terms of using past behavior? Or?
Yeah, totally. I think these oracles, the next bullet point is where I describe that, but these oracles are on the hook too. Their opinion is going to cost them if they're wrong. So they're going to be incentivized to be right. They're going to be incentivized to dig as much as they need to take on a new person as essentially a risk to them. And that's in the claims process. So if your doctor, okay, let's deal with health insurance. So if your doctor is your oracle and they've represented you at a certain amount of risk and they got you a policy, they're your intermediary. They're the ones that interact with the insurance company on the blockchain. So if something goes wrong, you break your leg. They are the ones that will submit that claim. And specifically for health insurance, just to kind of avoid collusion, I'm entertaining the idea that the payout doesn't go to the doctor directly. It goes to the person with the policy, and they reimburse the doctor, just to try and make it, one more hop. But that is the general idea. The underwriting and the claims functions are going to be performed by oracles. Those oracles are going to be incentivized to be as honest as possible, and they're going to be the intermediary for people that want insurance with the blockchain. They give a fitness score that's calculated by some risk model that they run in-house, and that way they don't ever have to publish your data publicly. They just publish a score. So the next one is where I talk about how these, maybe not. Well, maybe it's the one after this. So in this one, it's another repositioning of assets, or human resources, I mean. Actuaries were the people that drafted those risk models. Now they are smart contract developers. So you have an insurance system that has a list of products that insurance products that you buy a policy for. Somebody had to do the work of figuring out what's that risk matrix look like, and what are the factors that are relevant. And so actuaries are the best, are in the best position to do that. So they will do that analysis, that data mining. They're going to work with the oracles and say, to do this data mining, we need access to historical policies. So there'll be some negotiation there.
Do you see our personal information being more secure or less secure? I can see it going either way.
Yeah.
I can see it looking at Facebook to see whether we're going to carry something in the policy or not. But if all they're getting is a number based on whatever criteria, then it's actually probably less than they're getting now. So it's just about what happens to personal data.
Right. So I understand what you mean. The risk, or the data risk, is data is now being spread to all these, let's say, doctors' offices, something like that.
Well, my thought is right now, okay, so let's say you want to do health insurance, or life insurance. Okay, so for life insurance, they're going to come in, they're going to take blood work, they're going to check for HIV and whatever they're going to check for. And then information goes back to the insurance company, which is it's a lot of information secured by the insurance company. I'm assuming they're going to be asking the same sort of information from the oracle, which is somehow get combined into a score. So from that angle, all you're getting back is a score. You're not really getting blood work tests. You're not really, you may know that on a scale of 1 to 10, I may be a 2 and not be covered, but you won't know why I'm a 2. So from that angle, it's more secured, but my concern is the amount of information that they're looking for to get to that point, whether it's they can go to Facebook and pull whether you're drinking, binge drinking, and having indiscriminate sex.
Right.
So there can be a lot more information that's not really readily available now that they're looking at.
I'm glad you brought it up. I should have said the actuaries are negotiating for direct access to your data, not the filtered down number. They want raw medical records. They want to, and so that's why there's a bit of a negotiation. But that's privileged data. So the actuaries are most likely going to be bigger corporations. That this is the function. Like you take that group of 50 or 100 analysts and actuaries that used to work for an insurance company, and they pool up, and now they're a small corporation. And that's all they do. They specialize in creating new insurance products.
How would it be regulated?
Well, they'd have to be, subject to existing HIPAA or whatever. But it would be a very focused, tight corporation that's highly specialized in doing smart contract development, specifically insurance product development. And white paper. I'm just throwing ideas out.
I'm just throwing ideas out there.
Yeah, totally. So I do think that it is important to say these actuaries are going to be working directly with oracles, getting access to privileged data. They're going to be performing a normal data mining or statistical study like they do today, but their end result is they write out a smart contract, and they publish a risk matrix that gets sent to all the oracles. They have access to it. They can download the risk matrix if they want to use that product for one of their patients. One of the reasons these actuaries would want to do this is because if their product is being used, they get a portion of the premiums. So they're incentivized to, one, produce a product that gets used, and two, produce a product that doesn't fail. By fail, it's just, it's so loose on risk that the pools blow up. So I introduced the idea of this reward structure. An actuary is going to make their smart contracts. They're going to propose them to the system. They're going to put them in a queue of potential products. Everybody gets a chance to look at it and say if they want to incorporate this product into the official list of products offered by the company. They vote on it. And then once it gets voted on and people can now use this product, ask for this new insurance product, they would, all the rewards from people using it for 1 year, and that time scale could be adjusted, the rewards are locked, and they're held in a reserve account. So they'll accumulate, every premium, a little bit goes into that reward account, and if the pool doesn't fail within a year, if the product doesn't fail within a year, they get the money. But if the pool loses, and this is arbitrary, we'd have to figure out the real numbers, but I said if the pool loses more than 20%, it comes out of their account, everything over 20%. So they're incentivized to make a safe product, and it has to be safe for some amount of time. I said a year, it could be longer or shorter. But after that, if they've produced a safe product that doesn't blow up the pools, then they get everything. There is no time locks anymore. They can get that fraction of a premium continuously. And it's going to encourage other actuaries or smart contract developers to try and make new products and new ways of harvesting those premium payments. All right, this is the one I wanted to talk about earlier. So one of the grievances with insurance today is it feels like the insurance company and the customer are sometimes competing with each other because claims get denied or fraud gets committed and things like that. So because we're getting rid of the company, there are no employer interests anymore. These oracles are free agents. So you're minimizing denied claims, but you might be maximizing fraud because doctors could just submit unlimited claims and collect all the pool. So the oracles have to be on the line. They have to pay part of the claims, and that's what these collateralized trust networks are. an oracle that's going to stand between you and the insurance company and submit those claims, they're going to pay a portion of the claims they submit. So I put together, again, these are nice round numbers, but they pay 2%, let's say. And in the white paper, I put together an example scenario. It's a trust network because these oracles get a reputation score. So other oracles are going to vouch for them and say, I think this guy's trustworthy, and the more people that vouch for him, the better he looks, the better his reputation is. But those, I call them trust references, if I'm Oracle A and Oracle B, C, and D say they trust me, when I submit a claim, I'm on the hook, but they're also on the hook for a portion of it. So those references cost everybody a little bit. They really have to believe you. And
So we're talking about like actuaries. I mean, the people who are right now kind of doing the risk analysis, like Moody's or what happens to those kind of established third parties? Do they morph into something else, or is this something where kind of have some more bottom-up risk analysis happening, or?
So when I think of Moody's or Fitch or somebody like that, I'm thinking like they're rating bonds or some sort of deal structure, something like that. Is that what you're thinking? Like
Yeah.
That's the function they perform?
Well, I guess the how do you, in this case, how do you determine that risk level?
So for the actuaries, they're going to be looking at a bunch of historical policies, let's say health policies, and they're going to be looking at the people, the metadata, like not the actual personal information, but maybe like age, weight, zip code or something like that, some semi-scrub data, and they're going to try and tease out for this group of people, these were the claims that came in, this was the cost of those claims, and I think these are the risk factors that contributed to it. Like, oh, this person likes to rock wall climb, or they live near a beach and they do a lot of water sports, or whatever the risk factors are. So the actuaries are actually doing the risk analysis. And actuaries exist right now in insurance companies doing that exact thing. That was a really simple example, but they perform risk analysis on all sorts of insurance products. So at least for these collateralized trust networks, this is not my own idea. This is there's a research paper called Trust Davis that kind of formalized this idea of building a reputation network, and then everybody that vouched for you is on the line a little bit. So big round numbers, I said, the trust network takes 10% of the hit of every claim. The person submitting the claim takes 2%, the trust network takes 8%, and after a claim goes in, or let's say before that, so you get a reputation score. The more collateral you have in your personal collateral account, the better your reputation looks. The more, the larger your trust network, and the more collateral they have, the better your reputation looks. So submitting a claim that causes your trust network to fall apart, for people to stop trusting you, that will drop your reputation score precipitously. Half of it comes from your collateral account, half of it comes from your network. If your score drops below a threshold, so I said, I think 75%, if you have a reputation score less than 75, all the oracles have the option of reviewing your claims before they get paid. Otherwise, if you have a high reputation, they're immediately paid. All those numbers could be massaged. The insurance product may say every claim gets reviewed by at least one other oracle in your network, so just to avoid collusion. But the central idea is you have a trust network, a group of people that say they trust each other, so much so that they put money on it. Your or an oracle's reputation score combined with an individual insurance buyer's fitness score, those two things come together to determine your premium. So The lower your fitness score, the lower the reputation score, the higher your premium. And that really means that if you're a customer for an Oracle and their reputation score is dropping and your premium is going up, you're going to be incentivized to go look somewhere else. So Oracles are always going to want to keep, they're going to focus on what can they do themselves to raise their reputation in order to keep premiums happy or low, to keep people happy. But they're also going to want their individual customers to do things to lower their risk, to improve their fitness. There is always a situation where somebody's going to say a 10% payout, isn't that bad because I can collect, this huge amount of money just for a 10% payout. And who cares if I blow up my trust network? It's the last claim I'll ever put in. I'm going to make $1 million. There's always that scenario. And the Trust Davis model actually recommended 100% collateralization, so the network paid for everything. All the reserves were embedded in the network. When you're talking about $1 million life insurance policies and things like that, I don't think you could accumulate enough money in the network, or it would be too unstable, I think. I don't know. You couldn't get Oracles to sign up for this deal. So I think it has to be some lower amount. But the point remains, everybody's kind of on the hook. I think that's how you solve a little bit of the fraud in the claims process.
Are you familiar with the whole credit karma in China they're doing with the social credit?
No, what is it?
You know what credit sesame is? Is it credit karma or credit sesame? Credit sesame. You know the online scoring for your credit card, for your credit score?
Yeah.
Apparently in China they've added a social element to it, where basically you vouch for other people and you get scored on your social worthiness and political views. Well, regardless, but you're basically vouching for other people, and what happens is if you pick the wrong candidate or the wrong whatever, you lose points and your social worthiness goes down and you get scored on it. Apparently, it's religious and for jobs and employment and probably everything.
Yeah.
But
well, I mean that is the point. With all of this, it's beyond social shaming, because at least you felt like you could redeem yourself. In models like this, maybe it ends your business if you lose too much reputation or something like that, lose too much collateral. So, or you submit a big claim and all of a sudden your whole trust network got burned and they dropped you. And so everybody's premiums shoot up and then they all leave. So there has to be some equilibrium, some safeguards that are baked into these trust networks to prevent that. I mean, the worst case scenario is somebody gets, the doctor themselves drops a patient because they know the claims that are going to come in are going to cost them too much reputation. There is that concern, and that is a problem in the existing insurance schemes. So it's not solving all of it. In fact, I feel like that might be a bit of a cultural problem versus where what I mean by that is maybe charities are contributing to reputation to cover costs or something like that.
Can you quantify a little bit better on the hook as far as someone who vouched versus, I guess the big guy is mostly on the hook, obviously, and then a voucher or a voucher for a voucher or something like that?
Right. So I only went out 1 degree, but maybe it could go out multiple degrees.
I think it might need to.
Yeah, that would be.
Of course, that makes it super complex, but that's your problem.
Well, but if it's small enough and I see your point. It actually is a good idea. So
I'm already thinking of ways to be broad. I don't want to think like I'm saying.
Well, so on the hook in my simple model was 10%. And so 2% comes from the person that submits the claim, 8% comes from the network. And so if you have 16 people in your network and it's a $10,000 claim, you paid $2,000, and everybody in your network pays $500, something like that.
that reserves are built up with premiums.
And then reserves, yeah, capture everything after that. Yeah.
The reinsurance companies kind of, in my dim understanding of it, sort of do something like this sometimes. Not like this, but kind of, they spread risk in that way that you were just talking about, where
Yeah.
it's not a disaster. I don't know.
Well, and it's usually like, you know, above this amount, or there's various. Actually, I do incorporate it. I think it's the next bullet point after this one. But reinsurance is crucial. You know, it doesn't go away with this model. So the next shift, and this is something I'm seeing already happening in insurance today. A lot of company pools are like the traditional insurance model. There's a ton of startups lately over the last 2 or 3 years that are peer-to-peer models, and they're customizable peer-to-peer models where you can say, just me and my friends, and we're only going to cover, you know, car damage up to $3,000 or something like that. So small pools, but the mechanics of their peer-to-peer pools are what I was most interested in. So I guess some of the big ideas for it are it's still a reserve fund. You have a share of the pool that you're liable to pay into, and depending on the insurance product, after you've paid in your share, your premiums start dropping just because you've covered your amount. For let's say a given term, like every year, if no claims came in, you might actually, depending on the product again, get some of your premiums back as some sort of benefit for being claim free in the pool. If claims do come in, but they don't lower the pool reserve too significantly, your premiums will go back up. They were approaching zero. They'll go back up, but they'll only require enough from you to top up the reserve fund. So the idea for the biggest benefit here is when you don't have all the infrastructure of a big corporate or big insurance company, you're not having to pay for buildings and agents and all that sort of thing. And so the assumption is you can get pools that kind of have stable state or approach stable state. That's the hope. And you don't have to live off of interest income. As long as you've got a certain amount of money in reserve and a certain amount of reinsurance for everything above the reserves, you can approach stable state. So just a simplified way of saying costs should be lower if you do it this way. And then finally, the part that we were talking about is reinsurance. There is no real transformation for this. This portion of the insurance, the existing insurance model, would pretty much stay the same. You're going to do, so reinsurance is just insuring the insurance pool, usually for some amount of money over a certain amount, or for really extreme scenarios. So there's 3 kinds of structured products or reinsurance that I imagine. The first one is when a pool is first started. So you've got all these people that want to buy life insurance, let's say, and all these investors that want to buy bonds. And they both put in their bid and their money to start the transaction, and they're just waiting for enough people to accumulate on the pool side and enough people to accumulate on the structured or on the investor side. And when those numbers are right, you know, this is all determined by the specific insurance product. It'll say how big does the pool need to be, how big do the reserves need to be. Whenever that happens, a pool is created. All those insurance buyers are put into the pool. Their initial premium goes into the pool, and all the money from the investors goes into the pool as a reserve fund, and those investors get bonds. And they're going to get paid back on those bonds from the monthly premium payments. It's just going to go from the insurance buyers over to the investors. That's called value of in-force business, VIF. They do it already, but it's a way you can start a pool with $0 and immediately get enough funds to form reserves, so that, you know, if claims come in day 2, you've got money to back it. And also, you know, it's a structured product, so you've got a certain amount of those bonds that you sold to the investors are AAA rated. There's very low chance they're ever going to default, but they're getting them 1.5%. And then you got a certain amount of those bonds you sold that are, triple B, but they're going to get them 8%. But also those triple Bs, when claims come in or things go wrong with the pool, the triple Bs lose their money first. And so certain investors can deal with that. They do it today. VIF financing is very common from what I saw, and it seems to be the biggest concern for VIF financing is when people stop paying their policies, when you get these default rates and the premiums aren't flowing through. So somebody's going to need to maintain the pool. Somebody's going to need to add new, if the pool's already formed and people are dropping out because they're not paying, but people are queuing up, getting ready for the next pool, the system's going to be putting them into the pool to top it up, to make sure the pool's always got the right amount of reserves, the right amount of coverage, the right amount of members. The other kind of, reinsurance. This is what we were talking about. There's two kinds in particular. One is for property, and they call it a catastrophe bond. And it's just that. It's a bond that, the investor gives you the money right now for the bond, and they're getting a tiny fraction of the premiums, but they're also going to get their money back, in a certain amount of time, unless, and the catastrophe bond has different terms, but let's just say it says, we are insuring a pool, and if we lose 25 properties in the pool, you'll start losing your money. If we lose 35 properties, you lose all your money. And so there's kind of these extreme scenarios where you'd have to have, a hurricane come through or something and affect multiple properties at once. The human equivalent of that is something called extreme mortality bonds, and that's just same idea. It says if we lose 25 people at once, you start losing your money. We lose 35, you lose all your money. And so investors will buy these kind of bonds because they're extreme scenarios.
The black swan, if you will.
Yeah. All right, so this is kind of a topological diagram showing major components to this blockchain insurance system. So these would all be organizations of smart contracts or functions that belong to smart contracts. Big blue blocks are going to be the functional sections of the system. Light blue blocks are voting members or voting users. Yellow blocks are data storage. Green blocks are currency accounts. And orange blocks are processes. So the big blocks are governance. You're going to need a way to organize board of directors, and you're going to need a way to update the system. So in this model, you're submitting code changes. And code changes get voted on by all the voting members. So if somebody says, we need to add in a new feature that isn't here at all, they would submit a code change, and at a certain interval, people would vote on incorporating it or not. There's four kinds of voting members: the board of directors, the oracles, the insurance holders, and the investors. And the math is just easy. You have 25% of the vote comes from each group. And so there's 9 board of directors, but there could be thousands of each of the other things. And each group is liable for, can only contribute their 25% to the total percent. So board of directors, code changes, in the voting process for submitting or for approving code changes is the governance model. There's also the idea of hiring out work, like I was talking about earlier, pay for performance situations. That would also be part of the governance process. So somebody would submit a smart contract that says we need to get on the front page of Google, and here's what the bounty would be. And everybody would say, yeah, that's a worthy cause. Let's approve that. And then that contract would sit out there waiting to be satisfied. So gives us a way to update the system, gives us a way to add new features, also gives us a way to solicit work in a pay-for-performance scheme using in a democratic fashion in the governance model. The governance model is really almost an island. It does interact with, it does have a dependency on one other functional area, and that's the treasury, and that's specifically dealing with the DAI cryptocurrency and how do we do the exchanges between dollars to DAI or whatever national currency. It really is kind of a lightweight use case though, because everything that's happening here is actually being handled by Maker. We're communicating with Maker and saying we need to exchange in or out of DAI. So everything else here is really kind of building up to the pool. Oracles have a registry of everybody that's registered as an Oracle. Oracles have collateral accounts, and Oracles have the trust network. And then there's the Oracle trust scoring process, or their reputation scoring process. On the insurance product side, we've got a product registry. Again, products are voted into existence or voted into the registry, so they live in this new product submission area until they get voted on, and then a product that gets voted on and is being used accumulates a reward. Investors are also in a registry of able investors. There's also a registry of all the structured products that are active. When premiums come in and they go through the structured product distribution process, the money accumulates in an account for that investor, and he can reinvest it or withdraw it. The other side of the investor model is the actual insurance buyers, and they are over in the insurance pool area. So you've got different insurance pools for different products. You've got all the insurance holders are registered in the system. The insurance pool has a reserve account. The insurance holders have their own premium accounts where they put their premiums and wait for them to be processed. And then insurance holders have a payout account. And there's a few processes that are significant to pool management. One is the claims process. One is the premium payment process. One is the payout process if a claim gets approved. And then the final one is worst case scenario, pool liquidation. If something goes wrong and the money has to be returned to everybody, how do you liquidate a pool? So the way that things get into the investor area, or the way that things get into a pool, is they accumulate in the market. And so you're going to have investors submitting requests for, they're just saying, I want to buy a bond at this much and this kind of a bond, this kind of term or whatever. And those requests accumulate. And then you've got Oracles submitting requests for insurance. And they're saying, this guy wants a life insurance policy for this coverage, and when I priced him out, this was his premium. And so they just accumulate here. The funds get deposited ahead of time, so the first premium is put into the insurance requester's account. The bond payment is put into the investor's account, and then at some point, the structured products get created and the pools get created and the money swaps. And there's a process for that. How do you create a structured product? How do you create a pool? And then how do you calculate premiums? So these would be the functional areas that I'd be thinking about if I was building this system, and some of the processes and some of the separation between various classes of contracts, the voting users, the data storage, currency accounts, or processes. So these are the users, the external component to that, that would need to interact with this system. So you've got board of directors. These are real people. I suggested 9. They vote. They have very few real tasks, but they do vote on updates to the system and new insurance products. The oracles are the intermediaries, so they supply trusted information about the new insurance buyers, and they submit the claims. Some suggestions for who oracles could be: it could be your doctors, it could be your car mechanics, it could be building inspectors, and you can imagine other people that are the most informed or the most capable of submitting the most timely, trusted information. The investors are going to fund a new pool, or they're going to be the people reinsuring the pool. The insurance buyers are paying premiums for their policies with specific coverages. The smart contract authors are creating new system features or new upgrades. So these could be people that are just looking to update the system in general, not create new insurance products, but they just want to make version 2 of this, or version 3. Then you've got the actual insurance product creators, and they're the ones that are they're the big data analysts, they're the actuaries, the statisticians. So then there's a few automated systems. One is the DAI custodians, the ones that are the gateways between dollars and DAI, or whatever. This is a piece of software that runs on a server, and it just operates the interaction between the two legs. There are the paymasters, and paymaster is just going to it's going to watch the premiums accumulate, and then it knows premiums get processed at this time, at this date, and so it's going to kick off that action. It's going to interact with the smart contract, pay the gas to get the process started, and the smart contract takes over from there. All the money flows through the structured products, flows through compensating the product creator, it compensates the paymaster themselves, and then it puts any remaining into the reserve account. Lots of people are going to be racing to do this function, or any of these automated functions, competing with other people trying to complete these functions. The trade settlers are the ones that watch the people that want insurance accumulate, and they're going to watch the investors accumulate until the requirements for that product are met. So if it says we need 1,000 people in the pool and we need 100, or let's say $10 million in reserve, it's going to wait for those two conditions to be met, and then the trade settler is going to kick off the process that makes the structured product, makes the pool, swaps the money, and then they get paid for that. And then the last one is the pool maintainers. And so, like I mentioned earlier, people stop paying for their policy. And so they need to be dropped out of the pool. People are accumulating, waiting to get into a pool. Or a pool has lost so much money it needs to be liquidated. It's hit a threshold. So the pool maintainers are just watching the pools for those conditions. And they're just running these little maintenance tasks to get people in or out or liquidate. And they're getting compensated for each one of those tasks. So if I was going to build this system, the first thing I would say is it's got to be open source. There's really no way to do this otherwise, just for practical reasons. Everything in Ethereum, when you upload your smart contract, everybody's got a copy of it. So, there's no way to hide that. They're going to look at what you did. The next thing is, for a system like this, it's less important, I think, to build a very specific, tight solution for insurance. It's more important to focus on all these functional groups and look at them in terms of how can they be reused, because things like this oracle management, the trust networks, these structured product systems, we're talking about a financial system, Ethereum. They're going to be extremely relevant to other products. So I think another principle for building this is focus on system reuse. And the final one is, at this juncture in the game, there's no assumption that shouldn't be tested. Everything's up for debate. One of the initial assumptions I had going into this was we can do it better. We don't need the insurance companies. We can build a system that can function without a central company managing pools, managing underwriting claims, and I still hold on to that, but I haven't done the numbers. I haven't built enough of the structure to say that that's true. So there's probably a lot of assumptions I've made. Feedback is going to be critical as building this thing goes forward. So creating some reusable subsystems. The first thing is governance, treasury, and the DAI custodians. Those systems are going to be relevant not just to this DAO, but a lot of other DAOs. So I would build those pieces first. The next one is the oracles and the collateralized trust networks. Some of the research papers I've been reading on the way to writing this white paper need this immediately. So that's going to be one of my focuses for this year, is building out what that would actually look like, those collateralized trust networks. And the last one is the investors in the structured finance cash flow engine. Again, this is a financial system, Ethereum is. Structured products are going to make their way in. Somebody's going to build this stuff. I built a few structured finance cash flow models on, as prototypes as I went along. So I think I've got a little bit of a handle on how to build some cash flow waterfalls. So that'll be another system I'd build right away. And all of these things would be before I'd even start working on an MVP. I would focus on building the things that are going to be most useful to other projects first, and then say, well, what would an MVP look like? I suggested a life insurance product, low chance for fraud. Claims are very, generally speaking, they can be spread out a bit. And then finally, just the incremental improvement. You got an MVP that kind of works. It proves the point, but there's a lot of things you left out. I'd start adding in those individual components. So really, that's it. This is a process that would take years, I think, to not just like to build it, but to get it to a point where people feel like it's viable. But I do think there's some things that can be done in the beginning that don't require anybody else's opinion. They're subsystems that are relevant, and so, in my opinion, this is worthy work to be doing. At least going down this path in general. Everything else I had was just some information that I thought was relevant. This presentation is on the meetup, so the white paper is here. It's kind of terse reading, but all the bullet points, everything I've shown you here is in the white paper in exhaustive detail. I was managing myself on a Trello board, but as I continue this project, I'm going to continue using Trello to just manage the tasks. And then I started a code repository. It's private right now, but I'll open it up probably within the next week or so. And it's got some of the prototypes, a lot of the working material for the white paper and things like that. The company that I've started around this is called Pure Money Systems. Pure is an acronym. It stands for Personal Universal Real Equity. My idea there is I feel like new money systems should give everybody a stake. Everybody should have a fair shake. And so that's the intent. Build money systems that are fair for everybody. So email, Facebook, Google+. Pure Money Systems is, again, my GitHub account. I have several repositories covering all sorts of things. And then I'm working on a website. Maker is worth looking at all by itself. I think they're going to be a significant force in cryptocurrency, running on top of Ethereum, providing a fiat-pegged currency, a cryptocurrency. I think they're going to be significant all by themselves. They're in alpha, like they haven't really released much more than a governance structure. So they're issuing two currencies. One is the DAI, the fiat-pegged one, and one is another currency called Maker. I don't think I think you have to do purchases through personal sale, so it's worth getting on their Slack channel and just getting to know some of these guys if you're interested. And that was it. A lot of bulldozing. Thank you, guys. Well, like I said, I found enough things along the way to where, I mean, it's just like an engineer to like start imagining the next thing when they're halfway through the thing they're working on. But I do feel like at some point this idea and I are going to part, and I'm going to take a few of those subsystem pieces and start building the next thing. One of the downsides of this is it just requires so many people to agree. And that's not a good way to build any sort of business, I don't think. So it's an idea.
Well, I think when you have the specializations spread out, maybe that won't get into the regulatory issue. Like health insurance, you might be able to regulations say that it has to cover a bunch of stuff. But in this case, maybe they'll do like custom insurance. Who do you see? It's all kind of spread around.
Yeah.
Give it all.
I hope so. And I hope that, I mean, I have a few friends who are doctors, and they complain endlessly about how horrible it is dealing with the insurance companies for legitimate claims. So much so that one of my friends goes to DC regularly to lobby for bills that are going to give them a better relationship with insurance companies. So it's getting to the point where I think doctors are becoming political. Like not just in having an opinion, but wanting to have some control over their lives. I read a statistic along the way that said 54% of doctors are discouraging their kids from going into healthcare. And, you know, yeah.
And I'm curious to see what happens once healthcare becomes more of a device-oriented, kind of how that interaction works. Instead of saying you go to your nurse, once that tricorder hits the market, right now I already have a friend who's working on a smart thermometer, which, is already storing huge amounts of data on, everybody's body temperature.
Yeah.
So I just have a feeling like this is going to go hand in hand with that.
It's going to be huge. All the, whether it's biofeedback or the device in your car while we're still driving that monitors your driving patterns, or the smart connected home, whatever it is, those, I think that's inevitable.
Okay, so how about we say thanks for coming, both in person and to everybody online. I'm just going to shut down the computer, and then, we'll be able to kind of continue the discussion offline. Okay, thanks for coming.
So what do you think is the biggest challenge